Hello.
How you doing?
Right. Technology is a phenomenal thing when it works well. Uh, let's see how it holds up. So first of all, David, thank you for coming online.
You're welcome.
Thanks for spending some time with me today. Okay, so for those that don't know who David Holloway is, I can't believe how rough I look, really, but oh well. But tell us, David, who is David Holloway? What's David Holloway all about?
Sure. So yeah, I'm not particularly sort of prolific, kind of online social media and all that kind of stuff. I guess I've got three property hats. I'm a portfolio landlord. I do developments, but the third hat, which is effectively ending at this moment in time, is my kind of main background, which was as a property professional. So I trained. I started out running health clubs for sort of first half of my career, fairly sort of large scale stuff, and then went into effectively a startup health club, and we had a plan of rolling these things out across the country. And the reason I got into property really was the first project that we did. I was the kind of if you like, the general manager of this business, and had all these property professionals coming in, and we had all these things I didn't quite understand, like overspends and delays and all that kind of stuff, from supposed property professionals. So I went effectively back to university. I studied at University College of Estate Management in surveying and construction management, and effectively from there pivoted into that career and had a sort of career in commercial property, building all sorts of things from offices, health clubs, even football stadiums, that kind of stuff. And the last role of that was for LV Insurance, acting as their head of property, where we've just finished, hence the reason I'm kind of now pretty much full on with the development stuff, but we've just finished the sale of part of the LV business to Allianz, which was effectively a £1 billion sale. So, big money, lots of property transactions, lots of property lease stuff, legals, making sure that, each site had the right resilience in terms of sort of their IT structures and all that kind of stuff. But I'm pleased to say that went well. That all completed in December, and it's just a bit of mop-up stuff now, and now it's kind of full on with the development. For the last 2 years, I've had a development company. The last project we did was 8 units, with a further 2 units gained, or planning uplift gained in the rear. And thankfully, we are kind of exited that now. We've still got a couple of units to sell, but effectively it's pretty much just our money left in, which I'm pleased to say is a very, I'm pleased we're in that position and we're not mid-construction. And, we'll talk about that and some of the challenges that maybe some other people are facing.
Yeah.
So, so that's me.
Okay, so brilliant. So we've got lots of experience, not only from a residential point of view, but also from a commercial point of view, which is fantastic. And that's probably one of the reasons why I got you online.
Sure.
So bear in mind that probably our audience today is probably more residential orientated. What sites are currently on, or what sites are you currently just about to finish in terms of residential, and how has this kind of affected you? Has it brought you to a standstill?
Well, I think I'll come on to that, but I think the first thing I would say is that whilst all of this stuff is going to affect all of us from an income perspective, from a from earnings, from debt, and all that kind of stuff, I think we all just need to take a little bit of a pause and put ourselves in the context of kind of where we are. Hopefully, none of the people listening to this are either affected themselves or have their immediate kind of family affected and so forth. And I think whilst I've seen a lot of stuff online about, what's going to happen with this and how can I pay my bills and debt and refinance and all that kind of stuff, I think those issues would pale into insignificance if we were directly impacted by, the sort of ferocity of this disease. So I think kind of first and foremost, I'm grateful, and I hope everyone else is, that we're not immediately impacted. Obviously we're going to be impacted in some way, but not kind of immediately impacted by the actual kind of disease itself. So in terms of the immediate project that I just referred to there. So that was effectively buying a site that had 8 very uninhabitable houses, renovated those, sold some, still got a couple to sell, and then carved off, created the titles, created the freehold, sold the freehold, all that sort of stuff. Created planning, or got planning approval for units in the rear, and effectively now we're at the point where it's just our money left in. So whilst it's not ideal in that our cash is tied up, it's not really costing us anything other than a slightly reduced return on capital employed, because obviously it's going to be in that scheme longer. But I would much rather take that position than.
In that respect, then, what's your plan? Is your plan to potential refinance on those units to try and pull some money out initially, or are you just going to keep it there for the short term?
Yeah, so we have done that to an extent. So the money landed in our account this week, actually, but about 3-4 weeks ago, we started the process when this first happened, saying, right, look, okay, this might affect the sales of those last units. Can we pull some cash out by refinancing and effectively taking some of our money out as debt? Which is exactly what we have done. Although the impact to us on that, and I'm sure this is going to affect an awful lot of people, was the original terms that we had versus the final terms that we had. In our case, it meant we've got a lower loan to value. Understandably, the banks are being risk averse. Their first priority is always to protect their debt position, not so much obviously worry about your position. So the net effect to us was we took out about 50,000 less than we hoped to, but we still took the view that effectively by refinancing, that's going to give us 12 months, which is hopefully more than enough. Hopefully we don't need 12 months to sell those final units, but nobody knows. We are in really uncharted waters. I don't think anyone has a crystal ball right now, and with estate agents not showing, buyers getting nervous, maybe their lenders have changed their terms, all of those kind of things, is going to add to the length of time it takes to sell units. That's just the way it is.
Yeah. As much as I hate it, I hate the term now, uncharted waters. I hate the term of unknown territory. But it is the fact that in actual fact, we have actually been in a market where we've gone through recession, like the 2000-2008 bust. So we kind of understand the implications as to what that has on the market. I appreciate that.
I disagree a little bit on that. I get what you're saying, but I heard a great quote the other day, so I'm not going to take any credit for this. I'm just going to read it. But it said, we have to consider the outlook and appropriateness of value in the context of unprecedented uncertainty, and this is the key point, and the total absence of guidance from analogies in the past. Because whilst, yes, we had the financial crisis of 2008, I think, without wanting to, it might pass and it might just be a moment in time, but I do think there will be maybe a second wave. But there isn't anything to compare it to. It's impacted so many people in so many ways. I think it's going to have an impact on obviously the retail sector, what the high street looks like, and all those kind of things. At some point, this debt has to be paid back. This kind of early term that was used about mortgage holidays, completely the wrong term. It's not holiday at all. All of those kind of things. So I think, yes, we can. You always try and draw on the past and learn from those experiences, but I don't think, very few people can use any sort of obvious kind of analogy. What it does do for me, and particularly in the development sector, is we always bang on about having minimizing your risk, having multiple exits, not over leveraging, right? And if you use the analogy of a planning term, when I had a site in London that I did a few years ago where we had to design for what they call a 1 in 100 year event. Now, at the time, and this was relating to drainage. Okay, so they're saying, right, you need to design this for a flood that might happen once every 100 years, and it added some money to the scheme. It wasn't ideal; it was a bit of a pain, but this in sort of overall investment terms is exactly the same. It's that 1 in 100 year event, and it will hopefully. I know it's going to cause some people some short term pain, but hopefully it will educate people that the key issues of not over leveraging, not just riding the wave, having resilience, having multiple exits, and all those kind of things do matter, because this is going to impact some people. Some people are going to not be able to recover from this, going to be too highly leveraged. And as sad as that is, it does bring home those points about having different exits and so on and so forth.
Okay, interesting. No, very interesting points. And I can only draw on, as we speak today, I don't have any live developments, and to be fair, that's probably one of the things that I'm quite grateful for. Got lots of buy-to-lets, got lots of HMOs, so I've got lots of other things that can cause me pain, so to speak, like having tenants not pay me rent, or draw on the mortgage holidays or the rent-free periods or whatever you want to call it. But in terms of developments, I'm quite thankful that we managed to get out of our development earlier. Well, when I say earlier, it was late last year. So
right.
Out of sites, we managed to get out, so we're pretty completely offside, and it worked. That's worked really well. Now, one thing that I started doing, and one thing that I was going to ask you on, is that I've got a couple of sites that we've currently got going through, but I've done them on options, planning options. So we've got the option to purchase once we've got the planning gain in place. Now, I'm looking, and over the last couple of weeks, I have been looking at the purchase price. I've also been taking into consideration what our new potential GDV, what our new potential gross development value is, based on the fact that we may get down valuations of circa 20%, and what that is for the whole overall score, and whether the scheme's still viable. I mean, from your point of view there, what's your thoughts to that?
I totally agree. I mean, it depends on where you are in the cycle. If you're in that stage where you are purely looking at, or you have the option, I mean, that's the ideal scenario. If you've got, as you have, options on those, then absolutely, this moment in time, I would be pressing the pause button, not pressing ahead based on the assumptions of GDVs, because I don't think anyone could, if you look at the impact of other indicators, oil's at its lowest price since, I think, 1973, stock market's taken a hit, etc. Housing, whilst less liquid, will have, an impact will be felt in some way, shape or form. It might be short term, it might not, but, timing is everything. And when you're looking to exit, those may have an impact. So in terms of that first phase, I would be looking to stress test what's the worst case. What if, even down to, let's say you were further along the line, supply of materials, your brick kilns and all that kind of stuff, I suspect have stopped. So that means that there's going to be a demand when it recovers. So that is going to push the price of that up, and other raw materials and that kind of stuff. It really demonstrates the value of an option, because if you've got that option, you've got the opportunity to progress, but not the obligation. And right now, that's the perfect scenario, and hopefully, sorry, just one other point. No one, I'm assuming, is unaware of what's going on. So surely those land owners are gonna, or those homeowners, or whatever it might be, are going to understand that situation. So would hopefully be a little bit more flexible towards you going back and offering a lower price. Hopefully people aren't seeing this as sort of an opportunity, almost in a kind of vulture-like way. But I hope most people are going to understand the situation as well.
I completely agree with your point, because I had two options. I could have, technically speaking, I had three options. My first option is drop the site completely. My second option was that I could go in and potentially renegotiate on the price. And as you said, the vulture. So originally the site was the best part of £1 million. And I could have gone in and said, you know what, I'll tell you what, let's just based on today now, I'm now offering you 800,000 for argument's sake. Yeah. So I could have dropped 20% out straight away, which gives me my 20% buffer. Alternatively, what I decided to do was go with option number 3. And I decided, originally we had the option on the side between 6 and 12 months, where I would have to trigger the option to purchase. I've actually extended it just to over 2 to 2.5 years.
Yeah.
So
Yeah.
I said,
Makes absolute sense. Yeah.
and we've got the options. I said I can walk away now and say, sorry, it's not for me, it's too risky. I could either agree to buy it off you now, but at a price where I'm comfortable, which means that I would have been sitting on, first of all, I'll be paying out a lot of money and sitting on a site which is not producing any income. Alternatively, we could work on a way where I'll still give you the money that I've offered you today, but we've just got to prolong the timeline. And so luckily the owners come back to me and said, well, we can't afford to take that big a hit. So I presented all three options and they said, let's go with option number 3. I'll give you a little bit more time. We understand where we are and we're just adjusting the terms accordingly.
Yeah.
So,
Yeah.
you know, with all due respect, my intention with that site probably isn't even to build it out. It's with a view of getting the planning in place and then selling it with its new gain. But even if I was to get planning, who's going to be buying at this time for a site for the best part of 40 odd units?
Yeah, I think that's the point. I mean, I think I've seen again a couple of one of the good things that's come out of this is there's so many online meetings. The opportunity to network and connect is probably been greater in the last kind of 6 weeks than it ever has. I think the Baker Street property meet, which I've never been to before, had 1,000 people on it the other night. 1,000 people. I mean, it's, you know, phenomenal. And so yeah, there's lots of people, and you see a lot of sort of the common questions and concerns and that kind of stuff. And this I can't remember who it was now, but someone was asking the question, oh, you know, I might lose this deal if I don't sort of sign it now. Well, that might be the case, but equally, are there going to be loads of other people willing to pick that up at the same price? Probably not, because right now, again, no one's got a crystal ball. So don't be pressurized into proceeding along a certain route if you're not yet committed. You know, if your numbers don't tell you that isn't justifiable, and even if it did, frankly, I'd still look, as you've just done, look for an extension and not commit to anything, because, you know, we just I think we need a little bit longer. It's too early to say what the implications are going to be. It might, you know, even if the building sector gets back, does the end residential lending sector, for example, is the stress test for buy-to-lets going to change even further? So rather than just the 5.5% at 145 percent, is that going to change to give them more of a buffer, and is that going to kill some of the buy-to-let people that might have bought your units? Do you know what I mean? So you just don't know at this moment. It's too early to say. But that position where you are is a good position. For me, there's kind of 4 stages. Obviously, there's that stage where you've not yet committed. There's the point where you've already agreed and you signed based on terms. Hopefully, there are some sort of, you know, force majeure type clauses that can help you. But if not, you've still got this time to progress the planning. You know, planning offices are still open, albeit remotely, and so on and so forth. So you've still got the time to review that scheme. Learn about that stuff more. Don't just take the advice of your planning advisor. There's loads of stuff online, everything else. Can you get more out of that scheme than you previously thought in terms of additional units, greater footprint, extended PD rights, whatever it might be, so that you can use that as your buffer potentially to offset any higher interest cost or you know, whatever might be your situation. So that would be kind of phase 2. I think in terms of if you're on site and you're paused, then the first thing you've got to do is talk to your lender, because like I said, their first default position is to protect their debt position. It's not to look out for you. So you've got to talk to them. You might need to consider finding some additional equity or whatever it might be, but you've also got to understand how much that extra finance delay is going to cost you. There's going to be plenty of people out there, I think, that are going to be able to offer cash as equity, but be really careful who you get into bed with and what terms you enter it on. I'd only do that as a last resort. Your relationships with your contractors are also key. Hopefully you've got the right contract that any normal standard building contract would have a date for completion and penalties beyond that. Hopefully no one's relying on that. That's not the way to go, because your builder would just put in an extension of time counterclaim anyway, and then you're into a sort of a position of conflict. But if you're in that construction phase, I think you've just got to talk to everyone, try and work it out, and hopefully you're not too highly leveraged. If you're highly leveraged, it's going to be a rough ride.
It's going to be interesting, especially if you're on site, because obviously contractors need paying, contractors need to pay their employees, suppliers need paying. And, to be fair, people are calling in as and where possible, because their businesses also need to survive. They need cash flow to pay their suppliers and their members of staff.
Well, yeah. The only thing I'd say on that, again, it all depends on the structure of your contract, and hopefully you shouldn't be paying for works in advance. You should be paying at the right time, based on a proper valuation, and normally that valuation would be dependent probably on your lending surveyor as well. So it's got a kind of a second approval to it. And the reality is, if they're not doing work, then you shouldn't be needing to pay for that. I know that doesn't help them earn their income, but it does protect your cash flow in that situation. Certainly, I wouldn't try and do someone a favour in that sense of, well, I'll give you the money because I know you're going to do the work in the future. That's that's a bad position.
Let's face it, unfortunately, as great as they may be, we don't even know that they're going to be there in 12 months.
No, exactly. Yeah.
It's interesting, because I'm just watching who's coming online as well. We've had Andy Cook online, and I think we've had Lloyd come online. It'd be interesting to hear their thoughts at some point in the future as well.
Yeah. I mean, obviously those guys know what they're doing. They've got number of sites and that kind of stuff. So yeah.
So in terms of, just to recap then, David, so if someone's currently on site, have you got any hints and tips there, anything that you want to try and give these guys and say, well, here's what we should be doing? Well, you've mentioned that you should start to speak to your contractors, you should start to have a look at your numbers, you should see if you can extract further value out of the sites.
Well, I think if you're already on site, that's a tough thing to do. Hopefully you've already done that. I think if you are on site, then the first thing is just keep the communication lines open between all parties. This is not something of your doing. I know I don't mean you, obviously. I mean you as the person that is ultimately responsible for that site and accountable for that site as the developer. But everyone is aware that this has impacted and has limited people's ability. Even if the builder wanted to build, and even if they could do it safely, are they able to get the materials that they need? Do you know what I mean? So in that sense, I would see it very, very difficult. I could be wrong, but I don't see many sites continuing, unless obviously it's critical hospital work or whatever else it might be. I would think most sites are doing the sensible thing and stopping. Obviously there is I have to say, I think this government, you don't quite know how it's going to filter down in reality, but the initial response of supporting people, with the exception of directors who take dividends, that hasn't really been that's sort of been forgotten. But in terms of employees, if you're main contractor that's got employees and all that kind of stuff, then there is an awful lot of support. I don't quite know if it's reached people yet. I was talking to someone the other day, and they'd applied for a grant for their business, and they'd applied and it was there within 3 days, which was pretty good. So there is a lot of help out there, but I think you've just got to keep talking, just understand where your lender's position is. None of them can act right now. I think they need to, again, just err on the side of caution and not kind of jump in and just have you for default at this stage. But I think it's only a matter of time before that starts to happen.
I feel like I'm being the negative person today, which is not me, but I have to put into perspective where people are. So in terms of that, going back to 2008, going back to 2007, and the reason why I do that is because I draw upon my experience back from 2007, 2008. Now, as a development company, now let's just imagine that you, the developer, you went to your lender, you said the GDV is this, purchase price of this, development's this, and our margin's this. Do you reckon now that a lot of lenders, okay, given a bit of time, given a bit of sensitivity, they will now come back and start to ask for revaluations and see where they are in terms of leverage and gearing?
All depends on whether
because let's face it, David. If the GDV is £1 million and they've got leverage of up to, let's say, 800 grand, for argument's sake, because we all know that the margin is circa between 20 and 25%.
Yeah, I mean, the bank's margins aren't massive. They're making somewhere between sort of 3 and 10%. And like I said, they've got to protect their model. I'm not sure. I mean, obviously, most normal development loans are rolled up. The longer this goes on, the more that might be the case where people are coming back and saying, well, look, let's reassess this. At the end of the day, in the small print of all of these guys, effectively they can pull a loan at any time. If you're going back to that 2008, 2009, that's what happened with a lot of people. The schemes were still potentially viable, but the bank decided, look, we want to get our money back and recover our position and minimise our sort of, our debt risk. So in that sense, I think yes, there is a risk to that, but that's why I just go again, without sort of wishing to repeat myself, talk to them and just see where they are. But
back on a scale, just for argument's sake, just from a buy-to-let point of view, I can imagine lenders like the likes, to avoid what's happened with the likes of Mortgage Express and Northern Rock, etc. I can imagine a lot of lenders, especially commercial lenders like Lloyds Commercial, they trigger an automatic 7-year revaluation on portfolios. I can imagine lots of lenders may trigger a revaluation based on the fact that, let's just say, you put, again, talking very broad numbers, the portfolio is worth, £1 million, and let's just say that you've done 75% lending on it. So your debt level 750. Now, based on today's value, if that portfolio is now only really worth circa around 750, from the bank's point of view, they're pretty much 100% geared.
Yeah, I get that. I mean, the only thing I'd say on that, obviously, development lending is very different. If you're still in the same development after 7 years, I think you're screwed anyway.
Yeah,
so
I agree with that. A lot of them, bearing in mind what happened from 2008. The valuation before COVID was this. The valuation after COVID is this now. And if they're seeing themselves in a position where they're geared more than what they really wanted to be, they're either going to come back and say, put some equity back into the deal, or we're going to have to start looking at other options.
Yeah, I mean, it's a bit of a domino effect. I mean, the housing market is built on confidence, right? And we have, uncertain times, a huge amount of lack of confidence right now. So it is inevitable that some will, all of them will be looking at their positions and deciding what their risk profile needs to look like, and when the government allows them to, in some cases, or when they're able to, based on the contracts that they've got currently and the clauses that they have. Inevitably, they'll be looking to protect their position. But no one. Development is risky, right? No one's entitled to make a 25% margin. Just because that was in your original plan doesn't mean that that's what it's going to end up at the end. And if you're borrowing money and you're leveraging on that scheme, then they've got first charge. So you have to accept that that's going to affect your profit. If you use that kind of analogy of like a spaceship is only ever on its original kind of plan of its route for 2% of its time, right? 98% of the time it's course correcting. Well, this is one of the biggest course corrections we're ever likely to see in our lifetime. And some people are going to go backwards, and they're going to go backwards so far that they're going to lose the shirt. Some people are going to go back that they're going to lose a little bit of money. Some people are going to go back and not make any money. Well, better you kind of don't lose any money than lose a lot. So there's going to be people at different stages, but it goes back to that original point: how much you're leveraged, how strong the scheme was in the first, or in its reality, how strong the scheme is, determines whether you're going to come out of this with a profit or whether it's going to cost you. And people will learn from. Hopefully, people will learn from that. There's people that just think, well, as long as I've been on this course, so I've done this, I've done that, and I'm going to make money regardless. Doesn't work like that. It is a risky business. That's just the nature of it. What you can do is de-risk as much as possible. Look at other options. Can you pivot, for example, as an exit model into a housing association model? Like a lot of your stuff, a lot of your income comes from a housing. Well, that's great. And I've got not housing association tenants, but DSE tenants, or LHA tenants rather. I'm really glad I have, for a number of reasons. But at the moment, that's safe money. That's not private tenants. So, and actually, interesting, you'll know this far better than me, but my understanding is that those rates were recently reviewed. So the gap between, So the gap between private rents and LHA rents are therefore less. So is it the time maybe to look at, whether it be on development schemes, building them out for housing associations, that kind of stuff? Is that a model? I know that's getting a little bit more press and a little bit more coverage. I would expect that to pick up considerably. And there's what has been 1 million people applied for universal credit, like in the first week that this happened. Well, not all of those are going to go back to jobs. So there's going to be a bigger LHA demand than ever, I would have thought. As sad as that is, and hopefully, you're going back to your point about being positive. Out of all of this stuff will come some good, for sure. There will be opportunities, definitely in land, definitely in housing stock, but we've got to kind of just ride this this initial bit, and it may cause people to change their models, for sure.
It's interesting. To be fair. There's no, I should say, there's no right or wrong. I suppose I should better put out a disclaimer in here, David, that what we're not offering is obviously business or financial advice. What we're literally just sharing our experience from our background.
I agree.
So.
No, I agree. And it's interesting, again, on all these forums, there's lots of people that are absolutely adamant that X, Y, and Z is going to happen. It's just speculation. I don't think we can determine what's going to happen. We've just got to protect our positions as best we can. The biggest piece of advice I'd give anyone right now is just pause, just breathe a little bit. Look at your business. If it was in terms of kind of things that I would do right now versus medium term, just be grateful for where you are. Look at and reevaluate your health and your sort of family and all that kind of stuff. Look at your business model. Look at where the strong bits are, where the weak bits are. If you had this time again, would you have positioned yourself differently? And I'd be looking to sort of use the Stephen Covey term, sharpen the saw right now. One of the kind of seven habits, so that when use this time to learn, fill your knowledge gaps, speak to the right people, create the right relationships, so that when we come out of this, you are, your powder's ready to go. You're not ready to fire that shot just yet because you don't know where you're aiming quite. But when it does become clear, you are ready to go. That's what people should be doing now, not jumping in, not seizing on opportunities, because we don't know if they are opportunities right now. We don't know where the bottom of this situation is, so I don't think you can assess value quite too much at the moment.
So, David, we spoke a couple of weeks ago about something that we're going to potentially be looking at. I think that looking for sites now could be a phenomenal opportunity.
Oh, the desktop stuff. I mean, there's a huge opportunity to do the preparatory work right now. It's pretty much, I would say, 80% of the time that I have right now is spent looking for sites, doing the legwork, doing the research, contacting those landowners. We're very much trying to pivot our model now so that we're not so much doing the cradle to grave, find it, get the planning uplift, and you've got a fan. Get the planning uplift and build it out. We're looking really at that first stage now. So getting land that doesn't have planning, getting the planning uplift and exiting at that point. That's where we're looking to try and focus the vast majority of the time.
Okay, interesting. I think it's a phenomenon with everything, as we say, without acting, without sounding like the shark or without sounding like the vulture. There will be opportunities that arise from it. There will be people that have got land and that they no longer want to develop. There'll be opportunities where people have gone up and got the planning and the GDV and the figures haven't stacked up now, but there'll be opportunities. And the same with standard with buy-to-lets, people that may now need to sell more so as a result of everything else that's happened around them. Interesting that we've got one lady that's just joined us, and I would like to get her online at some point, Esther Bennett.
Yeah.
Get Esther at some point. Esther, if you're listening, send me a quick message. I'd like to do one of these lives. Just giving us an indication what the commercial market's doing right now. Commercial market, that'd be fantastic. David, is there anything else that you want to add to this?
No, just a couple of points really. In terms of, so that was what I'd be looking at the immediate term, but from a medium term, and this is just a view. It's not, like I said, no one can predict it. But I think, at the moment, cash is king. But where do I potentially see opportunity in the future? As you said, there's going to be people who have sat on land thinking that price is going to go up. I'm just going to wait to a certain point and so forth. And they maybe have needed the cash and realised that cash in the bank is better. So I think there will be opportunities in land. There's definitely going to be opportunities with HMO landlords who maybe enjoyed the cash flow but didn't particularly like the stressful side of running it. Well, now potentially they haven't had the cash flow because people haven't been working and they've got the stressful side of running it. So I think from where you specialise, there's going to be opportunities. I think this particular situation demonstrates the sort of fragility of the rent to SA and rent to rent model a little bit. Does it only work in the good times? That might create some opportunity for people. And I also think in commercial property, this I think will be a game changer in my own view, because with some of the people that I work with, right? So one of the people that I've done a lot of work with over the last few years, they've got about 2,300 people work in one building. At this moment in time, there's 20 odd people in that building who are deemed critical workers because of the nature of what they do. The rest of the people are at home, right? The cost of that facility is millions and millions of pounds a year to run, and yet the business is still functioning right now with those people at home. So I think there's going to be an awful lot of people who've just a lot of big companies who've accepted that, well, this is the cost of doing business. This is our property strategy, for want of a better term. We've got to have an office. We've got to have this. We've got to have that. And I think there'll be a number of people or number of businesses that look at that and change. And that will mean that there will potentially be more commercial footplate available to do other things with. I was speaking with a guy the other day who's a massive developer down here, sort of sitting on £2 billion of cash reserves, owns a huge amount of property, and he was pretty buoyant about the market, but he also knows that he's going to have an awful lot of people that are going to within his portfolio that are going to fold because they're not going to have been able to to meet those costs because they've got no income coming in. So that is going to create an opportunity for people.
I suppose you've got to have a look at it from the point of view that all these companies that have now made a lot of their employees work remotely, they would have saved a massive, well, they won't have saved a massive overhead yet, but if this business continues to run whilst they're working remotely, a lot of offices will become redundant.
Absolutely, that's the same. Yeah, so totally agree. Yeah,
there'll be a massive opportunity, but it's just a case of people that have got the cash flow reserves to take on.
I think we just got to wait. We've got to wait and see and I hope that's not the case for a lot of companies. I'm not wishing that, but I think unfortunately that will be the case. Hopefully it's more the people that go, you know what, there's an opportunity here. We don't need this big, expansive property strategy and offices in 16 different parts of the country and all that kind of stuff. Let's look at our portfolio and rationalize it, and that then will create some opportunity. But again, another saying, it's not mine, but I think it's relevant. When nothing is certain, anything is possible. We've just got to kind of trust the wait period a bit now, see where it goes, understand the opportunities before they arise, so that if they do arise, we can move. My focus is very much going forward going to be on the land uplift and the commercial property. That's where I see the biggest opportunity and where I'm going to be focusing.
Brilliant. I'm just checking for the guys out watching online. Are there any questions that you want to ask David? Because it kind of brings us to I think a suitable close. If you've got any questions that you want to ask David, please feel free to comment below. David, are you also happy if anyone does ask any questions? Or if you want, you can put your contact details, your Facebook profile page below, and people can contact you.
Yeah, just if anyone wants to reach out, if you are in development and you're not getting anywhere with your current broker and all that kind of stuff, I can certainly help. Try and put you in touch with some people that might be able to help. Reach out at david@dnadevelopments.com. So it's david@dnadevelopments. Drop me a line, or obviously find me on Facebook or LinkedIn. But yeah, listen, happy to help anyone if I can, for sure.
Brilliant. Okay, so man, I said great points. Thank you. So David, I suppose what we'll do, we'll touch base over the next couple of weeks. Let's see where we go from here, and then if there are any questions,
sure,
just keep checking in, just answer any questions, and we'll go from there, guys. But thank you very much for your time, David. It's been a great.
You're welcome. Take care.
All right.
Take care.